I think that some who would really like to hold on to at least a reasonably neutral outlook for the economy, or even perhaps one more sanguine, they could try to deal with some of the points you bring up by saying, well, the election exit polls were primarily a commentary on inflation. Or, and this is actually my view on one particular data point. The Michigan consumer confidence, I think, is always a lagging indicator that is not often validated by actual retail sales declining. And retail sales have not apparently declined a lot as credit markets have thus far held up. And so, being somewhat anti-Keynesian as I am, I've never put a lot of credence in consumer confidence as a leading indicator. But the labor data issue, as you point out, and the upside down pyramid analogy is important for people to understand how much is predicated in economic data on the BLS labor. Most importantly, as you point out, national income, gross domestic income, but then personal savings and its contribution to national savings, which of course savings being the bedrock of investment and investment being the bedrock of productivity. So there's a domino effect you're alluding to that is really profoundly important. I guess the question I would have is, given what we could at least agree is a vulnerable economy, people could disagree by degree on if the vulnerability leans to cautiously optimistic or perhaps others that are even in a full-blown, recession warning camp. There's a vulnerability, and now we're entering a new trade regime where baseline tariff rates are going higher, even with countries that we have formed the framework of a deal, whether they're in the good nation list right now of UK, Japan, European Union, Vietnam. Even those we're going to see significant increase in tariff cost from what they have been. And there's open-ended questions as to where the deal with China will go, which is by far the elephant in the room, perhaps more significant than all the other trade deals put together. But no progress with Brazil, with India, with other trading partners that are significant, not only to the global economy, but in what the cost represents to the U.S. How do you see this playing out, Lacy, in terms of where we are in the U.S. economy and what impact it could represent going forward?
Well, it's very significant, and I think people are going to be surprised when I give you a few numbers. Um, the tariffs in 2024 were somewhere between 2 and 3%. And based upon the latest numbers that I've seen from the budget lab at Yale University, we're approaching 20, which is the highest since Smoot-Hawley. It's back in that neighborhood. Now, to give you an idea, imports last year were slightly more than $3 trillion, 3.3 trillion, if I remember the number correctly. So if you have a tax of 20% on 3 trillion, you're going to raise $600 billion in taxes. Now there's going to be demand destruction, and so you won't raise 600 billion. But to think about it in another way, last year, corporate income tax collections were just a little bit more than $500 billion. And in the month of June and July, it appears that at an annual rate, the tariffs are basically generating almost a $370 billion annual rate of revenue. These are huge numbers. And so these are in no way a small element. They're monumental, and we haven't really witnessed this in modern times. Economists and econometricians have never had an opportunity to look at it. So all we can do is look at it theoretically. Now, here is the sequence that we have to understand: is that the demand for virtually all internationally traded goods is what we call highly price elastic. Very few price inelastic items. Gasoline is, it doesn't have good substitutes. Life-saving drugs don't have substitutes. I'm not an expert in the rare earth minerals, but they appear not to have substitutes. But everything else has a lot of substitutes. So the inelastic goods have something close to a vertical line, but in international trade, it's a gently upward sloping line. And I would say that the majority of items, excluding the ones I mentioned, probably have a price elasticity of 3 or more, which means if you raise the tariff cost by 1%, you're going to reduce quantity demanded by 3. It's a huge hit. And so when you impose tariffs, immediately the aggregate supply curve, or the industry supply curve, if you want to look on the micro, shifts inward, which gives you a higher price paid and a lower quantity demanded. And the instigator of the tariffs wins. But as soon as someone retaliates, and that's happening right now, then what happens is the demand curve shifts inward. And so after the retaliation takes effect, the price level ends up lower than where you started, and the aggregate demand, or the quantity demanded in the micro model, is also substantially lower. But this first round effect, or first and second round effect, also has consequences, because in so doing, there's a huge margin squeeze on the producers. And so what do they have to do? They have to reduce their usage of the factors of production: labor, natural resources, and capital. And so as the process evolves and the margin squeeze occurs, there is what I would call an endogenous reduction of liquidity. Now, most of us assume, as a general rule, the central banks control liquidity. It's exogenously determined. But in this environment, the instigation of tariffs and the retaliation cause an endogenous downward shock to liquidity, first round. Then immediately thereafter, when firms cut the usage of labor, natural resources, and capital, then you get a second endogenous downward shift in liquidity. But the process doesn't end there, because in the process of raising tariffs, what you've done all around the world is that there are tax, and they're very highly regressive tax. And so international trade begins to shrink. And perhaps it will shrink significantly because we're dealing with significant sums. And so what happens in that case, global trade volume comes down, and here's the kicker: so do global capital flows. Because the capital account, or net foreign saving, is the inverse of the trade account. And well, why is that important? Well, it's because of the trade surpluses, or the current account surpluses, that foreigners have been big investors in stocks and bonds and other assets in the United States. In the latest numbers, the foreign sector owns approximately $18 trillion of equities, $5 trillion of corporate bonds, $2 trillion of municipal paper, of MBS paper, and $7.75 trillion of treasuries. So what happens is, when the trade volumes come down and the current account deficits improve, then that also reduces the capital account, and you then get a major downward shock to liquidity. And here, because of that, you have to have the correct response from the central bank of the United States. the other banks won't do, because we are the central bank of the world. And in the period of the 1920s and the 1930s, when this process of beggar thy neighbor went into effect, the Bank of England, which had played that role prior to World War I, was no longer financially capable of doing so. And so they couldn't provide the liquidity to offset the endogenous shock. And the US central bank was not willing to take up the role. And so and this is called the Kindleberger spiral for Charles Kindleberger, a tremendous economist who wrote a great book called The World in Depression, 1929 to 1939. And he describes this process. And so as the liquidity starts collapsing endogenously, the central bank of the United States has to come in and offset the liquidity, or you'll get deflation. That's the risk.